Hello, ladies and gentlemen. You are warmly welcome to the Mid-Year Economic Review and Market Outlook webinar. My name is Mimi Ananiapia, and I'll be the moderator for this webinar. We are delighted to have you join us today as we share insights that would help you navigate the dynamic investment landscape. And to do this, we have arranged a lineup of speakers from our wealth management team to do one, provide an overview of the business, to share a comprehensive economic and market analysis, to deliver projections for the second half of the year. Each speaker will have 15 minutes to present, after which the remaining time will be used for questions and answers. Kindly, if you have any questions, please drop them in our Q&A tab, and we'll do well to have them addressed. Without wasting too much time, I'll hand over to Nana Riafe-Boama to give us an overview of Axis Wealth's operations. Thank you.
Thank you very much, Mimi. And good evening, everyone. And thank you for sacrificing a bit of your evening for this webinar. Before we go into the main reason why we are here, which is basically to discuss global market and investment outlook, aiming at informing how investors can position their portfolio for resilience in an uncertain macroeconomic environment, indulge me a bit to walk you through Axis Wealth Management and what we do for our clients. So Axis Wealth Management is a SEC-licensed investment advisory firm and is part of Axis Pension Group. We are basically the financial planning and wealth management division within Axis Pension Group. You may know Axis to be at the cutting edge of retirement savings service delivery. Our financial planning and wealth management division has been built to offer personalized and concierge wealth advisory services to all clients using only global financial products. Our client onboarding process begins with taking clients through our comprehensive financial planning process. And financial planning, basically, in this case, is how an individual or a family can leverage both their current and future financial resources to meet their financial goals. So during our financial planning engagement with our clients, we help them figure out, for instance, their cash flow needs. We help them imagine their estate planning preferences and help them think through risk management or insurance need. In addition to risk management, estate planning, cash flow, debt management, during the financial planning engagement, we help clients develop a personalized investment policy statement, right? That sets out how client assets can be managed, taking into account their return expectation, their risk preferences, their liquidity needs, and other circumstances particular to that client. Now, our approach to building a resilient global portfolio for our clients. The top 4 boxes encompasses our responsibilities in helping our clients think through their strategic asset allocation. And strategic asset allocation is the most important decision an investor will ever make. During the strategic asset allocation process, we help clients figure out how much equity or fixed income, for instance, that they should have in their portfolio. In equities, we help clients make decisions around what kind of equities they want. Is it developed market or emerging market? When it comes to fixed income, some of the decisions that comes in the strategic asset allocation discussion involves whether to allocate to credit or to allocate to treasury. The second box is how we go about our tactical allocation. And Peter will touch on this during his session. Tactical asset allocation basically involves minor deviation from the client's main strategic allocation to enhance return or to reduce risk in a very evolving global market. The third is our implementation guideline. For instance, do we use index funds, which is also known as ETFs, or single securities to expose client assets to the market? Our preference at Access Wealth is using ETFs to build our client wealth mandate. Lastly, we maintain ongoing communications with our clients every step of the way to ensure there's regular alignment of their interest and that of the advisor. And most importantly, to enable us to make quick changes in client portfolio if circumstances changes. We engage clients at least every quarter on their portfolio performance too. And today's webinar is an example of our ongoing client communication. Now, briefly touching on strategic asset allocation on this page. The top boxes represent how we come by strategic asset allocation for our clients. For instance, what is our client's risk tolerance? If a client is within the moderate risk bucket, right, how would they react, for instance, to a 30% portfolio drawdown during, say, a financial crisis or a pandemic, like COVID-2, right? What kind of portfolio drawdown is acceptable to you? We do recognize that all our clients, no matter their risk preference, want to maximize return at the lowest level of risk. And our job is to figure out what level of risk they can tolerate. We also need to understand the client investment horizon. Are they investing for 2 years, 3 years, or beyond 10 years? What are our clients' liquidity preferences, right? What are their spending needs? Are they retired such that, they need to definitely rely on their portfolio income to survive on a day-to-day basis? And our clients' unique preferences. So we run all this through an optimizer to determine what is an appropriate asset allocation for our clients. Over here, we explain how we execute our client wealth mandate after establishing their strategic asset allocation. We use only third-party financial products managed by some of the world's best investment management firms like BlackRock, JP Morgan, and Vanguard to build client portfolio. So Access is not peddling or selling any products of their own, right? And in selecting, the products we use, we like to state emphatically that we act very independently and go for products that helps meet client need. We do not have any commission arrangement with any of the fund providers, and therefore are able to objectively and independently select products that act in client's best interest. I know one or two of providers of such services in Ghana whose product push to clients is solely driven by commission they get from the third-party fund managers. Hence, they are very high front load fee of between 3 to about 7%. Also, in selecting products, as said in the earlier slide, we defer to the use of index fund or ETFs that track market instead of individual security selection. And our reason stems from how difficult it is to beat indices such as the S&P 500 and the other developed market indices. The platform we use in giving clients exposure to global market gives us access to every developed market, capital market, as well as most emerging market, capital market products. We therefore have options to customize portfolios to our client-specific needs and risk preferences. Our preference, however, is to manage client assets within what we call a risk-graded model portfolio, So for instance, a risk-loving client with long-time horizon, looking to aggressively grow their capital, have minimal need for portfolio income, may be advised to invest in an aggressive portfolio. And typically, our aggressive portfolio would have equity biased. And as we move down the risk scale from aggressive down to growth, to moderate, to conservative, and to income, the equity allocation decreases and the fixed income allocation increases. For a typical Ghanaian client who is so used to high yield or high interest rate, because of our macroeconomic environment, we have a yield booster portfolio that provides the opportunity for high income in USD, but not without the associated swings in market due to the daily valuation of that portfolio. So mark to market is a constant in global markets. Now, how can we help you? First and foremost, our services comes with free complimentary wealth planning or financial planning. On the minimum account we need to onboard you, we are currently at 25,000. And the 25,000 can be brought in bulk, or the client can fund the account within 12 months. And this account minimum is obviously subject to change at the discretion of the advisor. Because we want to serve our client, well, we may increase the minimum to allow for efficient and better service to our clients. Now, how do we ensure the safety of your assets, right? We do that by ensuring that the management of your asset is separate from the custody of your assets. So your capital is managed through your personal account, open in your name, right, at a global custodian. As this wealth will be given a mandate through the execution of an wealth management agreement by clients or with clients to manage your capital without having access to your money. So the global custodian is therefore responsible for the safekeeping of your assets. Our responsibility is to provide the best-in-class advisory services to grow your capital within your risk constraints. At no point do we have access to your money. And to give you further comfort, your account is insured up to about $30.5 million within the global custody we use. I would end my presentation here, come back after Peter's presentation, and walk you through our onboarding process. Carl, I throw the ball back to you. Thank you very much.
Good evening once again to our clients and all our cherished viewers. To put the half-year economic summary into context, we'll focus on key drivers of security return. Next slide, please. So essentially, to put the half-year economic summary into context, we'll focus on key drivers of security return, i.e., inflation and how it's influenced monetary policy over the 6 months. And we'll also focus on economic growth and how a combination of these factors have impacted returns in the first half of the year. Next slide, please. So the most dominant theme globally over the past 6 months and really over the past 24 months has been inflation. And you name it, US, Europe, and emerging markets, and even here in Ghana, countries have experienced all-time highs, if not near-time highs in inflation, caused primarily by loose monetary policy in reaction to COVID, as well as supply chain disruptions caused by Russia's invasion of Ukraine, plus the impact of COVID on economies. So as we can see in this graph, global inflation peaked in 2022 to 8.75 and has recorded the highest point over the past 2 decades. Next slide, please. The positive news is that inflation in major markets and economies we follow have begun to show signs of receding, and then it actually began to recede, with inflation, particularly in the US, falling to 3% and close to the Fed target of 2%, having hit 8% in the year 2022. In Europe, inflation has receded to 5.5%, and in emerging markets, down to 3.3%, very far off where we were 24 months ago. And that has been positive for markets. To fight the rising bout of inflation, which is one of the greatest risks to markets and the central bank's mandate, bankers across markets and across various countries have responded in kind by increasing policy rates to the fastest pace on record. In the US, the Federal Reserve increased policy rates by a cumulative 500 basis points. In Europe, by about 400 basis points, and emerging markets close to the same. This has been the fastest and the most aggressive pace of central bank increase in policy rates in the past few decades. Next slide, please. And what that has meant to markets is that short-term rates have increased by the fastest pace on record, as these rates are influenced by policy rates, while longer-term rates, that is 10 years and beyond, are influenced by growth and growth expectations as well as inflation expectation. Now, this phenomenon of rising short-term rates and slower growth has caused yield curves across major markets to invert, where you have short-term rates higher than longer-term rates. In major markets, as been in Ghana as well, you have T-bill rates and other short-term rates far above longer-term rates. And this phenomenon has led to increased calls by economists for a global recession across major markets. Next slide, please. The second major risk which economies have experienced over the past 6 months has been to economic growth and the call for economic growth to recede. Now, this call has primarily been made because of the fact that central banks have increased rates at its fastest pace, and the fact that global consumers will not be able to borrow money at such cheaper rates. However, the good news is that major markets we follow and we invest in have proved resilient, recording economic growth despite the calls for a recession. And these calls and this growth has primarily been driven by a strong consumer and increasing productivity gains across major markets we follow, driven by AI predominantly, and as well as countries continuously investing in technology sectors, driving up productivity. And that has driven global growth across the markets we follow. Next slide, please. And markets have responded favorably to this news of economic growth and lower inflation. Risk markets have recorded exceptional returns in the first 6 months of the year. The S&P 500 is up close to 16%. The NASDAQ, which tracks the US technology sector, is up north of 30%. The Russell 2000, which tracks smaller value stocks, up about 7%. And in emerging markets, risk assets are up close to 4%, and in Europe, close to 13%. So there has been a strong market return for risk assets across various globes and across various markets we follow. And for yield and income seeking investors, returns have also been positive, with ultra short-term rates in the US up 2.2%, Treasury bonds up close to 2% also, investment grade bonds at 3.2%, high yield bonds at 5.2%. And unfortunately, the only laggard we have is African sovereigns in USD down 0.9%. But that is essentially why we exist and we do what we do, to offer our clients the opportunity to diversify across countries and across regional exposures as well. Next slide, please. And on that note, I will hand over to Peter to walk us through the outlook for the rest of the year. Thank you.
Thank you, Carl. Thank you to all of our prospective clients and current clients and everyone who's listening to us this evening. We appreciate your time. My name is Peter Bewa. I'm a investment research manager with Covenant Wealth Strategies in Delaware, USA. I'm currently, consulting working as a consultant with Access Wealth Management, and in that capacity, I'm helping with the portfolio decision-making process. So before we get into the actual tactical allocation decisions, we're going to walk through a little bit of a background to where we were at the beginning of the year, where we are now, and basically what we expect the rest of the year to look like. Next slide, please. So our projection for the rest of the year continue to be positive. So full year conservative estimate of 1.2%. We're likely to exceed that target based on the numbers that came out recently. So the most recent quarter, which is Q2, the first estimate of GDP came out at 2.4%. The previous quarter, first quarter's GDP numbers were revised higher from 1.3 to 2%. So all indications show that there's no recession on the horizon. The economy continues to grow despite everything that has gone on with high inflation and high interest rates. The economy continues to hum along pretty strongly. As far as inflation goes, so to Carl's earlier points, global inflation peaked last year, 2022. That was the highest in decades. In the US, inflation got to 9% in June last year, and it's been receding since then. Every month it's been coming, it's been getting lower and lower. We estimate that before the end of the year, we'll be around a 3% target or even lower. So we're getting closer to the Fed's preferred target, which is around 2%. We think that inflation will continue to come down and get to the Fed's target, if not end of this year, most likely in Q1. In the lowest in decades, and it continues to go lower. So last week, the most recent unemployment numbers came out for the month of July, and it's even lower than the 3.7 that we have here. It's down to 3.5. And so there's never been a recession in the US with unemployment below 5%. So all these indicates that the economy continues to be strong, and that provides a lot of investment opportunities. Now, when we look at the Eurozone, we expect GDP to continue to stay positive, not as strong as the US, but it's going to be between 50 basis points and 1%. So not very strong, but it's not in recessionary territory, is what our expectations are. CPI is higher than the US, but it's also trending down. They hit 10%. Parts of Europe, especially in the UK, 10% earlier this year, and late last year, other parts of Europe, but it's also been trending down. Unemployment is also much higher than the US, but it's come down from where it was beginning of the year and sometime last year. So as far as the advanced economies in general go, we expect GDP growth to be around 1%. We expect CPI, which is inflation, to continue to come down below 5%. full year this year. As far as emerging markets go, we expect even stronger GDP growth. And so a lot of, various parts of emerging markets have had strong growth this year. One theme that continues to play out is India. India has seen a lot of growth this year. We've seen a lot of growth in Mexico, a lot of growth in parts of, South America, including Brazil. A lot of economies have been diversifying away from reliance on China, which had been the global manufacturing hub. But with experience, that a lot of countries went through with supply chain issues during the pandemic, they have been working to, build the infrastructure to be able to be self-reliant as far as infrastructure, as far as supply chain goes, and as far as having components and their own sources of supplies to feed their factories goes. And so we see that thing continuing to play out in emerging markets. Emerging markets have been some of the biggest beneficiaries. And so overall, we expect the global economy to continue to grow, GDP continue to stay positive. And so we don't expect a recession, on the immediate horizon. Next. So what does all those data points imply? So when we break it down into the various regions, why do we see investment opportunities in the United States? So like we said earlier on, inflation has been falling. That provides investment opportunities as far as, making the consumers spending, even stronger. So when inflation is high, it kind of adversely affects, consumer behavior, consumer spending. When, prices are lower, people are able to spend even more. We expect the Fed, they paused a couple of months ago, and they raised 25 basis point raise in their last meeting in the beginning of August. Now we expect that they are likely to either increase one more before the end of the year or be done. And so with all that being said, we are definitely closer to the end of the rates hike cycle than we were in the beginning. And even if they do raise one more 25 basis points, the impact on where we are on the cycle is much, much smaller than when they started raising beginning of last year. So to go from 0 to 3, 4, 5% has a much bigger impact on risk assets than 5%. So our perspective is, even if the Fed raises one more time before the end of the year, it's already priced into the markets. And so we're not likely to see adverse effects on on risky assets. So those provide investment opportunities. Can you please go back to the previous slide again? So as far as the United States goes, following inflation, the Fed, getting close to the end of the rate cycle, and also strong corporate profits provide a lot of investment opportunities in the US. It's not a situation where rising tide is going to lift all boats. You have to be very selective as to what sectors to invest in, and that's where active management, comes in. You need to have, companies with strong balance sheets that are resilient in turbulent times like these. And so we have to be selective as to what sectors and what companies to invest in. But there's a lot of opportunities in the US with strong, employment numbers, strong corporate profits, Fed, being about almost done with the rates hike cycle, and inflation, falling. Now, when we look at developed international, the Eurozone and Japan, the indicators that make those favorable is relative valuation. So asset prices are much cheaper, relative. Over the last, 9 months since the end of the 2022. And so valuations have kind of stretched, and so they're becoming pricier. Whereas in the developed international, Europe and, Japan and other parts, they've not seen such a huge, rise in asset prices. And so the valuation favors those places. And once again, active management is needed to identify where those opportunities are. And then when we look at emerging markets, there's a lot of geopolitical uncertainties, surrounding China and Russia. We all know what's going on with the Ukraine war. And also, China not really recovering fast from the COVID lockdowns. Unemployment is really high. For the first time, there's actually more, deaths in China than, new babies being born. So the population is, kind of starting to shrink from this year. And so those, are provide a bit of, headwinds. However, valuation and weaker, potentially, weaker dollar in the near future, still favor emerging markets, tremendously. Next slide, please. So with all that being said, the three major, sectors that we currently favor: consumer with very low unemployment. The only difference now is that consumer spending has shifted from when there was, lockdown and people were stuck at home. They were spending on, making expansions to their homes, by doing renovations or, upscaling to bigger houses. So the housing market, boomed. People were buying bigger houses to have space to work from home when they were working at home with, their spouses, and they had their kids also doing schooling at home. They needed a space. So people moved from the suburbs, from the city centers to the suburbs in order to, be able to accommodate the work from home phenomenon. But now that has, shifted since, the pandemic came to an end, and people are spending more on experiences. And so we've seen a lot of opportunities in the travel and leisure. We've seen airline stocks, do really well. Just yesterday, Delta reported earnings and they raised their guidance. We've seen that play out in a lot of, travel, stocks. So travel is a huge theme. Housing is still great, but it's, pockets of the housing market. And the reason being, the housing deficits, continues to be very, very, wide. There's more demand than supply. Fast over the last 12, 18 months, others are not, selling, their existing homes to buy new homes. So the inventory in the housing market is really low. However, that provides opportunities for home builders. And so there's a lot of demand for new homes, and home builders are capitalizing on that. We also see autos as a huge, demand, from consumers. And so those are the three main areas in consumer discretionary that we see opportunities there. We also like tech, really well. Semiconductors or chips, are in almost everything these days. And so chip makers are one of the, areas in the tech space that continue to do well, and they have a very long runway ahead of them. Software companies are also really, good place to be. AI, obviously, we've heard about all the AI phenomenon going on. So those three major themes make tech continue to be very, very strong space to be in. And then you add to that the fact that, we are towards the end of the rate hike cycle. When interest rates start coming down, it favors, growth stocks, which happen to have a lot of tech names in there because valuations become even better. And so when interest rates are lower, it makes valuations for those growth stocks, opportunities as industrials, due to the theme I mentioned earlier on, as far as reshoring and supply chain diversification away from, the previous, source, which used to be, China. And so we've seen a lot of, economies bringing manufacturing back, to their shores. We've seen, other emerging economies taking advantage of, the diversifying, away from China, trend. And so we've seen a lot of opportunities in industrials in order to capitalize on the supply chain disruptions that happened during the COVID, making industrials, also one space that looks really attractive. We are underweight to utilities, consumer staples, and real estates in general, particularly commercial real estates. So commercial real estate has been one of the areas that has been adversely impacted by COVID. Yeah, a lot of people didn't work in the office, they worked at home, and so it made commercial real estate values drop significantly. And then with interest rates going up so high, commercial real estates usually have to refinance every 5 years. And so when rates are really high and you have to refinance at a higher rate, it makes it even more unattractive. And then you add to the fact that for a while or very underutilized, it's made commercial real estate not very attractive in this environment. However, the other sectors that were not mentioned, we are more like market weight or neutral, to those sectors. And so discretionary tech industrials are the main themes that, we are currently advocating. And that will be it for my side. I will pass it over to Nana. Thank you for your time.
Thank you very much, Peter, for the insightful presentation. So, really, this is to go over, how, we basically onboard, our client or our process. So firstly, once the prospect expresses interest, we send them our financial planning questionnaire and then walk them through to complete the questionnaire. After the questionnaire is completed, we work on the client financial plan and then subsequently discuss the plan with the client. After the financial planning bit, is done, we guide our client to onboard on the Wealth platform. Two key KYC requirements to ensure compliance with AML laws would be the bio page of either your passport or your Ghana card, and also confirmation of your residential address. And the requirement over there is either your water bill bearing your name and bearing your residential address, or your bank statement reflecting your residential address. Once we have all this, it takes maximum 48 hours for your Wealth accounts to be open, and then we help you fund the account, and then we execute the strategy which would have been already agreed with you during the financial planning process for you. And then we monitor along the way and ensure that you inch close to your goal every step of the way. So thank you very much. Mimi, over to you.
Thank you very much, Nana, Carl, and Peter, for the insightful presentation. We'll head straight into our Q&A portion of the webinar. We received a few questions, so we'll answer those. Nana, this goes to you. How do I join and fund my account, and what is the process if I want to draw down some cash?
Okay, so how to join? Like I mentioned, ours is a financial planning practice as well as wealth management. So the starting point would be to go through the financial planning process with any of our wealth advisors, right? So we sit down with you, we ask you a few questions. It is a bit intrusive, and I know most Ghanaians are quite private, but to be able to offer this service, very well, you would have to open up on many things, including your financials, because when we have that full picture, we are able to then advise on what asset to have in your portfolio. So the financial planning process is the first step. Once that is done, then the wealth onboarding. It is done electronically. The key KYC requirements, as already mentioned, are your bio page of your Ghana card, both front and back, or your passport. And what
Hello, Nana.
Hello, Mimi.
Please go take it again. One more time.
Yes, so I mean, the key KYC requirement are your Ghana card and your evidence of your residential address, which is the bank statement bearing your name. Once that is done, the Wealth account is open for you, custodied in the USA. When it comes to funding your account, we'll provide you all the account details. Once your account is open, you would have an account number in the brokerage, firm we are working with, and then you would have to fund your account from your local bank account, complying with all of BOJ's requirements. And then once the money hits your account, we invest on your behalf. So that is how it works. Financial planning process first, and then opening of the Wealth accounts. When the Wealth account is open, you fund it and we invest on your behalf. So just reach out to us. This is the contact number, info@accesswealthmanagement.com or 020-703-5389, and then we can take it up from there. Thank you.
Thank you, Nana. Okay, so the second question goes to Carl. Is it advisable to invest in T-bills in this current economic environment?
It's a difficult question to answer straight ahead, because as part of a responsible investment process, we would have to have a good understanding of the client's investment profile before we can make before we can make a decision or recommendation towards investing in any particular security. So my advice would be for whoever's asking that question to reach out to an investment advisor so that they can go through the right process of beginning to invest, which is having the advisor take you through a comprehensive overview of your risk tolerance, investment strategy, what your investment plans are before a decision is made as to the right investment to undertake. That said, now the other question is the question in relation to is it a Ghana context or is a offshore context? And given where we are in Ghana's investing cycle, I should say, that question is perhaps not as straightforward as it would be. But broadly, treasury bills are supposed to be a risk-free instrument. They're supposed to give investors an avenue for liquidity. They are supposed to be an asset class where you can pack your assets and without any fear of losing your investment. So broadly, that would be my response. Mimi. Thank you.
Thank you. Sorry, thank you, Carl. Nana, this one goes to you. What is your recommended financial investment vehicle at the moment?
No, I think I'll let Peter take this.
Sure, Peter.
So there's no one-size-fits-all investment vehicle. And what we are currently, doing or providing to our potential clients is that we have access to every single asset class on a global, space. And so what investment vehicle we'll use will be determined by the client's situation and what their comfort level is. Some clients may not be comfortable with doing individual stocks, for instance. And so mutual funds and or ETFs may be a suitable, vehicle for particular clients. And others may be, interested in individual stocks because they may have preferences, for particular in companies that they want to invest in that may align with their values. But we do have access, to all the various vehicles. But it's, like I said, there's not a one size fits all. It all depends on the situation and the client's objectives and goals. I hope that answers the question.
Yeah, it does. Thanks, but there's another question for you, so please hold on. So the next question is, should the wealth management industry file a class action to defend investors or take responsibility for giving bad advice? This goes to you, Peter.
So there is always, bad actors in every industry. However, investing has the higher the risk, the higher the reward. What investment company or wealth management companies are supposed to do is to act in the best interest of their clients. We're supposed to be fiduciaries. And as a fiduciary, we're supposed to put our clients' interests before our interests. When our clients do well is when we do well. Now, where the firm put their interests before the client's interests, that is where the problem comes in. If the firm or the advisor is putting the client's interest first, and they disclose, everything is disclosed above board, nothing is hidden, all the fees or whatever, and things go sour, they can always, make a reference to, what they did. Obviously, you can't control everything, but as long as they did all the right things right, then, they can defend themselves in the court of law. But where, investment firms or wealth advisors have deliberately misled investors and mismanaged funds, yes, I do agree that there should be a class action lawsuit against such a firm. And so it all depends. It should be put in context, where bad actors have defrauded clients, taking monies that were meant to do XYZ, ended up doing ABC. Taking my clients' monies and commingling those funds companies instead of investing, they're investing in themselves instead of investing in companies. They definitely deserve, to be taken on. And so, first of all, you need to know, what advisor you're dealing with. You need to research, their background, their track record. And, this industry is built on trust. And so if you cannot trust the person you're dealing with, then you shouldn't, first of all, do business with. But if, you can trust them and they're doing everything the right way, how it's supposed to be done, then if things go wrong, it could be because, it was completely out of your control. But where there's a clear case of deliberate misleading and mismanagement, yes, I do agree that class action lawsuits should be brought against them.
Thank you, Peter. Okay, Nana, this one goes to you. Does Access Wealth explore investment opportunities in Ghana? And what is done to protect clients in that case?
Thank you, for the question. Mainly, for Access Wealth, our remit is guiding our client to navigate, global market Ghana. So no, we don't offer, much, advisory service concerning opportunities in Ghana. However, we believe that despite the uncertainty, despite the volatilities we went through, despite the mark-to-market that Ghanaian investors, were pulled through, right? Last year, ideally, we should have been doing mark-to-market, since day one. There still remain very, safe, viable, ethical investment management firms in Ghana that does the right thing. And I guess, the person who has, the question, should just, search, look out for some of those, investment firms and then speak to them on some of those, opportunities. Thank you.
Thank you, Nana. Before we take the next question, which is directed to you, I'd encourage you, if you have any questions, to drop it in our Q&A so that we'll have it answered. Nana, the next question is with the current economic uncertainties in Ghana, what advice would you give to long-term investments in their investors, in their early 40s with regards to investments in Ghana?
All right. So, tying that in the, earlier response to the most recent question, I would say, for any investor, you just have to go back to basic. Before you invest, you have to ask yourself, certain, questions, right? What are your goals? What are your time horizon? What is your risk tolerance level? Events, of 2022 should tell every investor that there's no free lunch when it comes to investment. Every investment, has risk. Unfortunately, the industry in Ghana is infantile. If you read around when mutual fund, started, we've barely, done 30 years in our industry, right? So mistakes, are bound, to happen. So whatever happened, last year shouldn't discourage, right, anyone from investing. For me, when I hear people saying, I'm not going to invest again, I'm not going to invest again, it's just like saying, you're not going to eat again because you ate some food and got some small, stomach, upset. Investment really is a necessity, right? Having, said, that the opportunities within, our market. I'm assuming the person who asked, this question and is 40 plus is probably thinking about his retirement, right? The third tier, pension system provides opportunity for me and you, right? To really retire comfortably. And I guess once you're on this platform, it's very likely you are working in a formal environment. Your employer probably is paying your tier 2, tier 3 for you. If you are privileged to have your employer pay your tier 3 for you, right, and you decide, not to touch it, I'm sure, despite, your age, you may go into retirement with a healthy, nest egg, because tier 2, basically is about 16% of your basic. Can you imagine investing 16% minimum of your basic, for 20 years? That would be, much money, despite all the uncertainties. So yes, there remain opportunities within the market, despite everything that has happened. Investors, are still making monies, both in fixed income and in equities. But what is important is, as an investor, you need to know what your goals are. Why are you investing? What are your risk tolerance, your time horizon, before you make any decision. And when you make the decision, know that every investment is subject to risk. Every investment is subject to risk. If it is not a liquidity risk, it could be market risk, because when interest rate increases, the value of every security, rarely falls or truly falls. It could be credit risk. If it is a corporate bond you're investing in, the corporate could default. If it is equity, prices could go up, could go down, and you would have no control over it. So the market and investors, should just embrace, market risk. The one who wins, ultimately is the investor who invests, for the long term. And we should just close our mind to some of the temporary blip and stay, invested and stick to our strategy, whether investing, locally or globally. Thank you.
Thank you. And I'll encourage all of us to keep our questions coming. We have another one. Is there a cap on how much one can start the wealth management?
So we do, expect, a minimum account, right, of $25,000 in client, balance. But then again, I tell people, between the client who would give me $25,000 and go to sleep and not add on to his money, and the one who can commit to say 3,000 or 5,000 every quarter, right, for the next, 10 years, I would go for the one who would commit to 3,000, 5,000 every quarter. Because by investing, new money, we get opportunity to, buy during different market cycle. So there is no minimum, but it would be hard, to work with you if you have, less than $25,000 in your account within 12 to 18 months coming, on board. Thank you.
You, Nana, and thanks to Carl and Peter for answering all our questions. And thanks once again to everyone for joining us. We do hope that you enjoyed this discussion and found it very insightful. We encourage you to speak to our advisors to discuss your specific needs. A form will appear once you exit the webinar. Please do well to leave your contact details and our advisors will reach out to you to discuss your specific needs. Once again, thank you very much and have a good evening.
Thank you, everyone. Bye-bye.